This week, we're going to be dealing with Chapter 13, which is accounting for bad debts. This is the last chapter that we're going to deal with in our book, and then we'll just kind of finish up the year with a review. But this is also one of the most important chapters because every business, no matter what you do, you have some accounts that people don't pay or they're going to have to write them off. And what do you do with it if you have some bad debts? And again, no matter what size of company you're going to have, you're going to have to deal with that. So when we look at bad debts are unpaid bills from customers. Sometimes they have trouble paying them. Sometimes they just avoid it, whatever it is. This does affect the company's future credit policy. The company is going to have to look at, do they want to be lenient? Do they want to be really strict? There are negatives and positives both ways. If you're really strict, you could lose profits because you lose customers because they know there's no credit. If you're too lenient, you also can lose profits because you are not getting your accounts paid. So you have to find that happy medium to see what's going to work best for you when you come up with your credit policy. The accrual counting and recording of bad debts. What we really focus on in this is matching our revenue with our expenses. So if our expenses happened in 2018, we want the revenue to match with it. And the bad debt expenses realized after the sale occurred. Sometimes that can take up to a year. So sometimes you can do the allowances and things like that we'll talk about. So we have the bad debt expense methods. There's basically two ways that you can do this with the bad debt expenses. The first method uses a percentage of sales. So what it says is the amount of sales that we have, a certain percentage will be uncollectible. So a business will look at their past, they'll look at what they've had and what they haven't been able to collect, and they'll say, like in this example, 1.6% of the sales will not be collectible. So basically, right now, they feel that $1,600 is not going to be collectible out of what they have sold for this year so far. There are two new accounts we're going to deal with. One is a bad debt expense. This has an expense as a normal debit balance. It works just like any other expense, is temporary and is closed into the income summary. Our other one is allowance for doubtful accounts, and this is a permanent account that is going to be a contra account for accounts receivable. So it's going to accumulate all the money that we think that is bad or bad debt or what we expect to be a bad debt, and it's going to directly decrease their accounts receivable. So in this example, if it's 1.6% of sales, which you said was $600, you're going to debit your bad debt expense for $1,600, and you're going to credit your allowance for doubtful debts for $1,600. So you're saying we're allowing $1,600 to be bad debt. When you look at this in the balance sheet, you will notice that it is directly decreasing your accounts receivable. So you have accounts receivable of $100,000 less allowance for doubtful debts, which says you really have, we're going to say we only have accounts receivable of $98,400. We may end up with more than that, but right now we're saying we have this allowance because we have not collected all this money yet. Writing off an account that you have said is bad or uncollectible, you have to look at reducing the allowance account, reducing your controlling account of accounts receivable, and updating their subsidiary ledger for each individual account. Doing this, you will notice that you will end up, if you have an account that's for $200 from J Moore, you'll end up debiting your allowance for doubtful accounts because that will decrease it. And your accounts receivable is also going to be decreased by $200. And it removes it from accounts receivable. We also have what's called the allowance method. So we're talking about bad debt expense. We have the expense method and we also have the allowance method. With the allowance method, we have the income statement approach and the balance sheet approach. The balance, we've already talked about the income statement approach. The balance sheet approaches focuses on sales. So a certain percentage of sales is going to be uncollectible. So in this example from 2015, they said $100 was going to be uncollectible. And so they have looked at and said, okay, we have a bad debts expense, we have allowance. We're going to take, or that is the count, I guess. $100 is already an allowance, sorry. We're going to take $80,000. They come up with $80,000 because if you take 95 of the sales minus your sales return allowance, your sales discount, then you get 80. Take a percentage of that. That is your direct write-off. As you notice, it adds up. The allowance now emphasizes the fact that there's a matching for the new balance. It carries over from year to year. And you'll notice that if it's not accurate, no problem. If the estimates are accurate, there's no problem. It just kind of works out that way. The balance sheet approach looks at your current accounts receivable and is based on how much money you have out. So it's not really based on your sales as much as it is how many people actually are owing you money. So this approach looks at aging your accounts receivable. And I'm sure many of you have seen something like this. If you go to the doctor, I know I got one from the chiropractor. When I got my bill, and it was 1 to 30 because I'd just been there for a month. But what it's going to say is this section had, the first section was 1 to 30. So that means that those are 1 to 30 days out. And then we have our 31 to 60, our 61 to 90, and our over 90. So it kind of estimates out how much do we think that we're not going to collect. We also have what's not due yet from each person. And we look kind of as the more that we have, the sooner it is, the more likely we're not going to be able to collect it. So if we look at what we have not due yet of $3,600, 51% of that is not going to be collectible. If you get down to over 90, we say 5% of that is not going to be collectible. So you kind of look at it and you age them out and you estimate, and then you add all those together. So you have, 3,600, 2,000, 870, 200, 330. And then you would look at that and say, okay, so our total accounts receivable then would be 7,000. And what estimated percentage we have over those. And then you get your adjusting entry. Your current balance is already $100. So that means you have adjusting entry of 350. Sorry about that, of 380. The aging of accounts receivable, then you would go bad debts expense, allowance for uncollectible accounts or for doubtful accounts. It could be uncollectible accounts. They could use whichever one they want. It's the same. Okay, using this one, the accounts receivable is deemed worthless. It should be considered as an asset at this point, should not be considered an asset. And so this would be if you're going to take it out of there altogether. Notice that your value is not going to really change. It's just where you put it. Because we already had an estimated realized value of 10,000 on the same side. It's just that we have adjusted where it's from. If we discover debts that are using the allowance, so if we're recording recovered accounts, so someone we wrote it off and then they repaid us, then you would actually have to reopen it up and take the money out of the allowance for doubtful debts, put it back in accounts receivable, and then you can pay the cash. You'll notice it's called reinstating the account. Another method we can use is the direct write-off method, and this method is used a lot for small businesses. A business that has not been a business for a long time and don't have record of their sales, what their percentages are, or they just have a hard time estimating their bad debts expense. So this means you're going to directly write off to the current year the bad debt expense. You're going to look at your year sales, does not matter. It's just whatever is bad at that time. As we look at this direct write-off method, there is no adjustments needed into the year. You just directly write off bad debts expense, that person. If they pay it, it's reinstated, so it's bad debts recovered. If they pay it off in the same year, then you just take it out of the expense account and put it back in the accounts receivable. So there's a lot to deal with recording bad debts. There's two different methods. Hopefully when you take your time, the assignments will specifically say, do you use the allowance method? Do you use the direct write-off method? So make sure you look at those and know which method you're using. Also, if you have questions, make sure you get a hold of me. I'm willing to Skype, email back and forth with things on you, but whatever it is to help you understand these concepts. So I hope you have a great day. and we'll talk to you later.